And good afternoon. Welcome into a Tuesday, December 1st edition of Market Talk. I'm your host, Jesse Allen. Great to have you here with us. You can find us on demand on all your favorite podcast sources, including Apple Podcasts, Spotify, iHeartRadio, radio.com, Amazon, Audible, and so many more. And online everywhere, markettalkag.com. Another interesting day in the markets to talk about. Let's bring in our guest. He is with agmarket.net. Brian Splitt is joining us today. Brian, how are you?
Doing good, Jesse. Thank you for having me.
I appreciate you joining us today, Brian. Let's jump right into this thing here. First day of December. We saw a down day yesterday in the grain markets. Maybe wondering, was that some position squaring, was some profit taking with the end of the month? And now we come back here today and down 5 to 6 again in quarter beans. Wheat was the largest percentage loser on the day. What is your take on what is going on in this grain market right now?
So you had mentioned yesterday, and that was to finish up the month of November. We had some rather aggressive selling across the board in corn, soybeans, and wheat. And, hard to differentiate whether it's end of the month profit taking or the beginning of something bigger. The concern of it being something bigger, I think, is drawn out on the charts. So when you think about corn, for example, the March corn contract yesterday made a new contract high. Then it finished on the lows of the day, and late in the day took out the previous day's low. So that would have been Friday's lows. Didn't close below Friday's lows, but still a negative day nonetheless. When you look at soybeans, that probably had the worst setup of all. Soybeans opened a few cents above Friday's highs, and not only closed below Friday's lows, but closed below last week's lows. So all of the lows last week. When you see today, we did try to rally early in the session on both corn and beans, especially as the dollar made new lows. They rejected that recovery bounce and again finished on the lows of the day. So I'm very concerned about March corn getting back below 420. We are still holding that, but not by much. And with the soybean market already having this big key reversal and taking out last week's lows, the size of the fund position in both should concern anyone that's holding long positions or physical grain in and of itself.
Yeah, Brian, let's dive a little bit deeper into each of these commodities and talk about them. Let's start with corn. You mentioned that 420 mark on March corn. We're right at that here today at the close. And looking at this thing, you mentioned we tried to rally. Is this a momentary hiccup, or if I've got corn in the bin, am I thinking about trying to make some sales?
Well, I think all along our mindset has been, you look at where March corn is, you look at the spread between March and May, and then May and July, not much carry in the market. We feel it makes a lot of sense, especially with as strong as basis is in a lot of areas, to go ahead and sell the physical crop and use the lack of carry in the market to reown it on paper with some July options. That way you're taking advantage of a strong board price. Obviously futures are in the March contract at 420. That is still $1 higher than where the December contract bottomed at 320. We have not much carry in the market, so it's giving you the opportunity to take advantage of a good board price, strong basis, and then with lack of carry, you're taking advantage of that by reowning it in deferred contract without carry in the market.
Well, and I know in comparison to soybeans, there are a lot of growers out there that are still sitting on corn in the bin after this year's harvest. So I think definitely more folks going to be out there looking at their corn balance sheets and seeing what they can move. And like you mentioned, maybe do some reowning on paper there. I think corn is a bigger conversation for a lot of growers right now because I think a lot of growers have sold soybeans at this point.
And that might be the reason why the producer is struggling to sell corn, because maybe they feel like they sold too many beans too early. So now they're gun shy on selling corn. But you can't tie one to the other, right? And so you got to look at what corn is doing in and of itself. And the market is taking away the advantage of storing it. Right. So again, we talked about the carry or lack thereof. So the market is not paying you to store it. It sure as heck isn't paying you to pay somebody else to store it for you. So we feel the most beneficial way to maintain ownership, if that's what you want to do, is to sell the physical and have paper ownership on it, which is more conservative. You're going to know what your risk is up front. if you just buy a call position in July. And that'll negate the downside risk of the futures market.
Brian, let's switch over to soybeans. We hit that $12 mark in the overnight on Monday, and since then we tumbled, and we're closing 1162 on January, 1163 on March today. 1158 out to July in the futures side. Beans, weather concerns. South America starting to get some rain, although dry pockets, high temps still a worry down there. But looking at the soybean market in general, what are your thoughts on where we're at? Are we going to climb back towards 12, or did we kind of hit the end of the line here?
Well, the reversal from yesterday's trade would suggest that momentum has shifted to down and not up. Could we go back to 12? Sure. I'm not going to ever say that soybeans can't go somewhere. 40 cents really in beans is nothing. But I think when you look at what we've done, we've rallied on our own domestic supplies, which we've seen reductions in yield and increase in the export assumptions. We've also had a rally on South American weather being dry, the expectation of La Nina. And one has to remember that when we top our markets, generally in summer, a lot of times we're topping in that June timeframe at the very beginning of summer. That's about where we are in South America's growing season. So we're at the beginning of their summer. So we know that $12 is major resistance. It's very evident on the continuous soybean chart. So that would be a question, is if we do have the South American weather forecast look a little bit more beneficial, they start to get some rain. Did we already price everything in early in the growing season? And that is very possible. So I've been recommending, in soybeans, if you're long, maybe you shouldn't be long anymore. Maybe you make the market make new highs above 12 before you say, oh, you know what, this rally is still good. But this market may give you an opportunity to buy it substantially lower if that's what you're looking for. And I can tell you the long-term uptrend on January soybeans is just above $11. So we could go down another 55, 60 cents just to hit the uptrend.
Yeah, it's definitely something I think a lot of producers, if they are still holding any beans, they're watching. The meal and oil markets too, we're kind of watching those tied in with the soybean market. And both of those here today, for the most part, traded lightly to the low side. What are you seeing in bean meal and oil right now, and how that's impacting the soybean market?
Well, I think maybe the most important part of it is not what meal is doing and what oil is doing as individually, but what the board crush is. And so the board crush is going to be the relationship between the soybeans and then the combined value of the end product. And right now, the crush margins have softened up substantially from where they were a month and a half ago. So the margins of buying soybeans, crushing it, and then selling the meal and selling the oil is not what it was. So that's a little bit of a concern. Individually, I don't doubt that you're probably going to see some unwinding, and especially, so we're going to be watching if there is developing problems in South America because of La Nina. It's not just Brazil. Another would be Argentina. And if there's a problem specifically in Argentina, that is going to be more of a product-driven type of a deal, where I think you're going to see meal really take over if that happens. Argentina will generally crush the soybeans and then export the meal. And we saw that in 2016 when they had drastic flooding down there. The bean market was strong, but once we really got concerned about Argentina, the meal market is what took over ownership of the rally, and that's when things got really exciting.
Let's switch over. Let's talk about wheat real quick. We saw higher winter wheat crop ratings out today, but for the most part, this market traded to the low side along with corn and beans here today. And, weather concerns have been the big thing we worried about a lot in wheat the last couple of weeks. Brian, what are you seeing for our wheat growers out there? What should they be watching here?
Well, so wheat, just like corn and soybeans, had a negative day yesterday. The same setup, outside day down, traded above Friday's highs, closed well below Friday's lows, and actually closed below several weeks of support on wheat. So the wheat chart probably looks right now the most negative between corn, soybeans, and wheat. We've heard talk about whether or not Russia might be able to increase their export forecast. They're talking that up. I don't know if we're on board with that yet, just based on the conditions of their crop. It's hard to imagine them being able to export what they're talking their target could be if the percentage of their crop is in poor condition, like they say. But that's been a talking piece in the market. I would like to think that as we come down and retest some support, that we'll find a place where the world market will like to buy and support wheat again. But when you think back to the November WASDE report, the corn report was bullish, the bean report was bullish, the wheat report was neutral. So wheat from that point was the weak leg of spreads. The market was buying beans and selling wheat, buying corn and selling wheat. And so now that everything has kind of lost its luster, the wheat's leading the way lower.
Well, Brian, let's move over to livestock. Hogs market, it was trading pretty confident this morning, but as we work through the day, hogs kind of finished to the low side. The deferreds, we saw a little bit of strength still in the deferreds, but it seems like that that momentum that had kind of developed in the hog market from Monday couldn't quite hold through today. What are you seeing in this hog market here as we move into the month of December?
So we had a very good rally in the February lean hog contract. The 200-day moving average has provided support. This was at the back end of November in that 63-ish area. We had a run up to almost 70 here. We're back up to retesting some old highs that we had back in September, October timeframe. So we are a little bit overbought. We're overdone on the upside. I think today we had what you would call a doji, and that means that you opened and closed at the same price. So the opening price and the closing price was 68.75. So what I would be looking at in the February lean hogs is selling weakness below today's lows and keeping a stop above today's high. So you'd be selling it on weakness below 68. And you'd keep a stop above the 69.60 high, and vice versa. If we take out today's highs after the doji, I want to buy that strength and keep a stop below today's lows. Overall, hogs have been trending higher. We've been trending higher since the beginning of April. So big picture, we still feel that dips are buying opportunities. Again, short term, a little bit of indecision. That's what these dojis usually suggest. And I do think if we see some additional weakness from here, we're probably likely to go back and maybe retest that 64.50 area on February. But I would expect, at least right now, that we would find buying support on a $5 correction on the Feb hogs.
Looking over at cattle, Brian, not a lot of cash cattle activity yet this week. Probably see some development after the online sale tomorrow. Marketplace, for the most part, sitting quiet, but feedlots seem to have the intention maybe to take the cattle market, the cash side, higher this week. But obviously, that's always easier said than done. Just looking at the board, mostly higher today, and got some of that strength back in live cattle that we lost on Monday. What are you seeing in this cattle market right now?
We're very range bound. For the most part, the February live cattle contract has been stuck in a trading range, 111 really being the low end of that trading range, and roughly 116.50 being the upper end of that range. And we've been in this range since about mid-July. We had a couple exceptions where we broke down below the low end of the range on concerns about COVID resurging, whether it was going to affect packing plants. It didn't. So those were kind of short-term sell-offs. And the cattle on feed report that we had at the beginning of November got us back into that trading range. So I'm really not doing anything on these live cattle. If we work our way back to the upper end of the trading range, around 116 or so, I'll be a seller there, risking to new highs for the move. And vice versa, if we go to the low end of the range, I'm likely to take off any of the short positions I already have. Depending on the individual, maybe we'll be a buyer at that low end if there's a reason to buy. If nothing else, we'll just be exiting shorts. But in the absence of that, back in September, we were selling straddles in live cattle and strangles. And so that would be, for example, a straddle would be selling a 113 call and a 113 put, which is basically in the middle of this trading range, and looking for time to decay out of it. Or maybe we sold some 111 puts and 116 calls, collected the premium on both sides, again, looking for time to decay in the market to stay within the range. But without the market really trading outside of this range materially, we're going to stick to more of these neutral type of positions until the market tells us otherwise.
And that feeder cattle market kind of dancing right around that 140, 141 mark, especially with the slight regression in corn that we're seeing here to begin this week. Trader interest is out there. Really just kind of seeing this feeder cattle market as well, range bound, but trying just be bound and determined to push a little bit higher here to start this week, it looks like.
Right. So we did have feeder cattle make some new highs for the move, and the January contract had some highs early in the month of November. And so we've taken out November's highs early in December. So at least for the short term, that looks like a good sign. I think right now you just have to be mindful. There's a grouping of moving averages on this January feeder cattle contract. You've got your 10-day, your 20-day, and your 100-day kind of all grouped in the same area around 138.20 to 138.60 in that general vicinity. So as long as we're kind of holding that grouping of moving averages, I feel pretty good about the feeder cattle contract. But if we take that out, and those are all going to be grouped right around yesterday's lows. So if we take that out, then I think you got to be on the short side of feeder cattle. But until that happens, I like the prospects of maybe going and up and retesting those August highs, especially if corn falls back a little bit further.
Yeah, that'll be something to watch for sure. Brian, you mentioned the dollar earlier. Any thoughts on that side of things, or any other final thoughts in general?
Dollar index, we've been trending higher for the last 9 years, and we are to start the month of December, we are taking out lows that were made back in September as we were finishing up the third quarter. So now as we go into the end of the year and finishing up the year, it looks like we're making new lows for the year. That probably does not bode very well for the outlook for the dollar index as we head into early 2021. And so I think it's going to be hard for the commodity markets in general to come under substantial pressure with the dollar breaking down below support. And if we do see this market break into the 80s, and we have an 80 handle in front of it instead of in the 90s, I think that it would exacerbate the scenario. But I do think that the dollar is a necessary component, and seeing this dollar trade materially lower into the low 80s is going to be a necessary component for some of the higher longer term targets to come to fruition on corn and soybeans. And those would be, $12 plus soybeans, and corn in the $4.50 to $5 zone. Mm-hmm. I think you need to have the dollar on board and really break down below support in order to see those markets achieve those higher prices.
Be something to watch for sure. Brian, if folks want to reach out to you and get a little marketing advice, what's the easiest way to do that?
You can reach me directly at 815-665-0463. I can reach anybody at the Ag Market team at 844-4Ag Market, so 844-424-6758. Check us out online, www.agmarket.net, and my Twitter handle is @BJSplitt.
Well, Brian, always great insight, and appreciate you jumping on the show here today. Thanks so much for the time, and we'll talk again soon.
All right. Thank you, Jesse. Have a good one.
Brian Splitt with agmarket.net, our guest today here on Market Talk. Find us online, markettalkag.com, and all your favorite podcast sources, including Spotify, Apple Podcasts, iHeartRadio, and so many more. This has been the Tuesday, December 1st, 2020 edition of Market Talk. I'm your host, Jesse Allen. Have a great afternoon.